Disclaimer.
They say money never sleeps, but looking at the COMEX vault data this morning, it's clearly having a nervous breakdown. I'm AG. While most of Wall Street is busy panic buying antacids over the Marco Rubio summit, I've been busy tracking the armored flights leaving JFK. Right now, New York is pricing silver at $88, while Shanghai is buying it at $120. That's a $34 secret, a literal infinite money glitch that is draining the West of its strategic future one bar at a time. If you think this 9% bounce is a recovery, you're missing the mechanical trap. The East isn't just buying the dip, they're buying the whole store while the doors are unlocked. Put down the hopium. Let's look at the math that Rubio and your bank don't want you to see. Right now, as I'm recording this, Marco Rubio is sitting in a conference room in Washington. Black SUVs line the street outside. Bureaucrats shuffle papers about supply chain resilience and critical mineral security. But nobody's talking about what happened yesterday. Nobody's mentioning the price boards flashing in Shanghai trading rooms this very moment. And that silence should terrify you more than any headline ever could. Here's what they're not discussing at that critical mineral summit happening today, February 4th, 2026. While officials debate policy frameworks and strategic reserves, trading screens in China are showing silver at $120 per ounce. Not the spot price you see on financial websites. The actual price Chinese buyers pay when they walk into Shanghai exchanges includes premiums and value-added taxes. Meanwhile, our COMEX futures in New York settled at $88 this morning. That's the $32 to $34 gap I just mentioned, the difference between what silver costs in their market versus ours. Think about that for a second. The same metal, the same ounce, two completely different prices separated by nothing but an ocean and a financial system that news fracturing in real time. Traders have a term for this. They call it arbitrage. But this isn't some minor pricing inefficiency that disappears in milliseconds. This gap has been sitting there for weeks, widening like a crack in a dam, and nobody with power seems willing to admit what it means. You want to know why Rubio called this emergency meeting? Let me walk you through what happened in the last 24 hours, because it tells you everything about why our financial system is hanging by a thread that's getting thinner every single day. Yesterday morning, news broke that President-elect Trump nominated Kevin Warsh as Treasury Secretary. You might not know that name, but silver traders do. Warsh ran the Federal Reserve during the 2008 crisis. He's known for one thing above all else. He believes in strong dollar policy backed by tight monetary control. The markets understood immediately what that signal meant. Within hours, silver prices collapsed from $122 per ounce down to $78, a 31% crash. The worst single-day drop since 1980 when the Hunt brothers cornered the market and it all came crashing down. But here's where it gets interesting. By this morning, silver had recovered to $88. That's not how manipulation works when it's successful. When Western banks want to crush a commodity price, it stays crushed. They have algorithms. They have derivative contracts stacked 300 times higher than physical metal. They have decades of experience making prices do exactly what they want. Yesterday's crash should have held. It should have scared speculators out of the market for months. Instead, the price bounced back $10 overnight like a beach ball pushed underwater and released. Why? Because someone said thank you for the discount and backed up the trucks. Chinese state buyers, sovereign wealth funds, industrial manufacturers who need silver for solar panels and electronics and military equipment. They saw $78 and they bought everything available. Every single ounce Western sellers dumped into the market got vacuumed up within hours. Our banks tried to execute the same playbook they've used for decades, driving down paper prices to shake out weak hands and maintain control. But this time, the metal just disappeared. Let me give you some context about what disappearing means. The COMEX in New York tracks something called registered inventory. That's physical silver sitting in approved warehouses, available for delivery against futures contracts. Back in 2020, we had about 1,400,000,000 ounces in those vaults. Today, we're down to 415 million ounces. That's a 70% decline in less than 6 years, and it's accelerating. You might think 415 million ounces sounds like a lot, but compare that to open interest, the number of paper contracts representing claims on silver. Those contracts represent claims on over 148 billion ounces. The ratio between paper claims and physical metal has stretched to 356 to 1. For every real ounce of silver in COMEX vaults, there are 356 paper promises, saying someone owns that same ounce. That's not a market, that's a confidence game, and confidence is breaking. Now here's what makes Rubio's silence today so damning. He knows exactly what's happening because traders can see it happening in real time. Western banks aren't just losing silver through trading losses. They're physically moving the metal themselves. JP Morgan, HSBC, other major institutions are chartering armored flights from London Heathrow and JFK to Swiss refineries. They're melting down American silver eagles, those coins with Lady Liberty stamped on them that were minted in our country to provide citizens with real money. They're recasting that metal into Chinese kilogram bars with 999.9 purity stamps. Then they're flying those bars to the Shanghai Gold Exchange where the metal disappears from Western ledgers forever. Why would our own banks do this? Because they're trapped between two impossible choices. They have a fiduciary duty to maximize returns for their shareholders. When there's a guaranteed $32 to $34 profit per ounce just for moving metal from London to Shanghai, they're legally obligated to make that trade. It's risk-free arbitrage. Buy at 88, sell at 120, pocket the difference. Every single time. Their shareholders demand it. Their boards require it. It's literally their job. But there's another duty these banks should consider. We're talking about American institutions moving American strategic resources to a rival power in the middle of the greatest financial realignment since Bretton Woods collapsed. Silver isn't just a commodity for jewelry and silverware. It's in every solar panel, every smartphone, every guided missile, every advanced electronic system our military depends on. We have zero strategic reserves of silver after our government sold off stockpiles decades ago in a deliberate effort to suppress prices and support the dollar. And now, when supply chains are fragmenting and nations are hoarding resources, our banks are executing the wealth transfer themselves because the arbitrage is too profitable to resist. The Pentagon has no silver stockpile. The Department of Defense has no emergency reserves set aside for weapons manufacturing. If there's a supply crisis tomorrow, our defense contractors will compete on the open market against Chinese buyers who own the mines, control the refineries, and have been accumulating metal for 2 decades. That's what Rubio knows. That's what he can't say out loud in a conference room full of bureaucrats drafting speeches about resilience. Because saying it out loud means admitting we lost the game before most Americans even knew we were playing. You want proof this is happening right now, not some future scenario. Yesterday's crash and recovery proved it. When Western banks smashed silver down to $78, they essentially put our national inventory on clearance sale. Everything must go, 30% off, giant neon signs flashing. Chinese buyers aren't stupid. They understand what that pricing signal means. It means our system is desperate to maintain the illusion of control, even as the physical market slips through our fingers like water. So they waited for the next big takedown, and when it came yesterday with the Warsh nomination, they bought everything. Absolutely everything. The scary part? This is just the beginning. That $32 gap between New York and Shanghai isn't closing. It's widening. Because the gap isn't really about silver prices. It's about two financial systems separating from each other like tectonic plates before an earthquake. One side is running out of metal. The other side is accumulating it faster than anyone in Washington wants to calculate. And the banks facilitating this transfer are the same institutions we trust to hold our savings, manage our pensions, and keep our financial system stable. So while Marco Rubio sits in his summit today discussing theoretical policy frameworks, the physical reality is playing out in armored cargo holds crossing the Atlantic and trading screens in Shanghai, showing prices our markets refuse to acknowledge. The silence isn't about protecting classified information. It's about protecting a system that's already breaking, one armored flight at a time. And every day that silence continues, another few million ounces leave our vaults and disappear into Chinese reserves where we'll never see them again. That arbitrage gap is still there right now, $32 to $34 per ounce. Still profitable, still legal, still happening. The question nobody in that conference room wants to answer is simple. How much metal do we have left? And how long until the vaults are empty? Let me explain how this wealth transfer actually works, because once you see the mechanism, you'll understand why it's unstoppable under our current system, and why that should concern every single American with savings, investments, or any stake in our economic future. That $34 gap between New York and Shanghai is not some temporary market inefficiency that algorithmic traders will close in milliseconds. It's systemic liquidation disguised as normal market operations. Here's the trade that banks are executing right now, today, while Rubio gives speeches about national security. Step 1, buy a London good delivery bar at $88 per ounce. Step 2, charter an armored flight to Switzerland. Step 3, melt and recast into Chinese kilogram bars. Step 4, ship to Shanghai Gold Exchange and sell at $120 per ounce. Step 5, pocket $32 to $34 profit per ounce with literally zero risk. You might be thinking that sounds too simple, too obvious, too profitable to be real. But that's exactly why it's happening at industrial scale. When you're a bank like JP Morgan or HSBC, you have what's called fiduciary duty to your shareholders. That's not optional. It's not a suggestion. It's a legal obligation backed by lawsuits and regulatory enforcement. Your job is to maximize returns within the bounds of the law. When there's a guaranteed arbitrage opportunity sitting in front of you day after day, week after week, you're required to take it. Your board of directors demands it. Your shareholders expect it. Your quarterly earnings depend on it. But here's where the nightmare begins for anyone who cares about American strategic interests. These same banks aren't responsible for protecting Pentagon missile stockpiles or ensuring domestic manufacturers have access to critical materials. That's not in their charter. That's not their legal mandate. The United States government sold off its strategic silver reserves decades ago in a deliberate policy to suppress prices and support dollar dominance. We have zero, none, not a single ounce held back for national emergencies or defense production. So when banks see an opportunity to buy at 88 and sell at 120, there's literally nothing stopping them except patriotism. And patriotism doesn't show up in earnings reports. Think about what this means in practice. Every single day, our financial institutions are making a choice between shareholder profits and national security, and the law requires them to choose profits every single time. The silver leaving COMEX vaults isn't being stolen by Chinese hackers or seized by government decree. It's being legally purchased and shipped by American and European banks doing exactly what they're supposed to do according to their corporate charters. That's what makes this so insidious. The system itself is executing the transfer. Now let me show you how China made this one-way valve permanent. On January 1st, 2026, just 5 weeks ago, Beijing announced new export restrictions. From now on, only 44 licensed state entities can export silver from a country that controls 60 to 70% of global supply. Think about that number for a moment. 44 companies in a nation of 1.4 billion people, all of them state-controlled, all of them answering to Beijing's strategic priorities, not market forces. What did this do to the physical market? It created a valve that only flows one direction. Silver can enter China through imports, through domestic mining, through processing and refining, but it cannot leave except through channels Beijing controls absolutely. Every ounce that crosses into Chinese territory becomes part of their strategic reserves, whether it was officially counted or not. The metal isn't coming back. Not at $88, not at $120, not at any price until China decides their accumulation phase is complete. Meanwhile, our paper markets keep pretending everything is normal. COMEX futures. Contracts trade 356 paper claims for every physical ounce in registered vaults. Let me put that ratio in perspective for you. Imagine your bank telling you they have your money in the vault, but they've also promised that same money to 355 other people. When one person asks for withdrawal, the bank has enough. When 10 people ask, they're scrambling. When 100 people show up demanding physical delivery, the whole system collapses because the money was never really there in the first place. That's our silver market right now. And the bifurcation between paper prices and physical reality is accelerating. Want proof? On January 2nd, Dubai silver coins were selling for $99.93 per ounce. Actual metal you could hold in your hand and walk out of the shop with. That same day, COMEX March futures contracts settled at $72.26. The same metal, the same time, but physical buyers were paying $27 more than paper traders because physical metal is actually scarce while paper promises are infinite. This brings us to the scandal that keeps Rubio awake at night, the one he absolutely cannot mention in public hearings without triggering a crisis. For decades, the United States government actively suppressed silver prices using paper derivatives, futures contracts, and strategic vault sales. The goal was maintaining dollar dominance and keeping inflation metrics low, keep commodity prices down, keep the dollar strong, keep the system stable. That policy worked brilliantly for American financial hegemony. It also created the biggest discount sale in monetary history. Every time Western banks smash silver prices down through paper manipulation, they're essentially putting our national strategic inventory on clearance. 30% off, everything must go. Giant neon signs flashing in financial terminals across Asia. And Chinese state buyers aren't stupid. They understand exactly what that signal means. It means our system values short-term price stability over long-term resource security. It means we'll sacrifice strategic materials to defend paper markets. It means if you are patient and you have deep pockets and you're thinking in decades instead of quarters, you can acquire industrial-scale quantities of critical metals while the West is distracted managing derivatives exposure. Think about the psychology of this for a moment. Every major price smash, every panic sell-off, every time Western banks drive silver down to shake out speculators, Chinese buyers are getting the same phone call. The metal you need for solar panel production, for electronics manufacturing, for strategic stockpiles, it's on sale again. The Americans are doing it again. Back up the trucks. Buy everything available. Convert dollars to physical assets while the conversion rate favors accumulation. This isn't conspiracy theory. This is documented policy. China announced their plans decades ago. They published white papers about resource security and strategic accumulation. They built the Shanghai Gold Exchange specifically to create price discovery outside Western control. They're not hiding their intentions. They're executing them in broad daylight while our banks are legally obligated to facilitate the transfer because the arbitrage is too profitable to ignore. Let me make this personal for you. If you have a pension fund, it probably owns bank stocks. Those banks are making profits from the arbitrage I just described. Your retirement account is benefiting from the wealth transfer. If you have a 401k invested in financial sector funds, same thing. The mechanism is so deeply embedded in our system that trying to stop it means fighting against the profit motive of every major institution in Western finance. You'd have to rewrite corporate law, override fiduciary duties, and explain to millions of shareholders why their returns are being sacrificed for some abstract notion of national security. But here's the thing about strategic resources. They're called strategic because you need them when you need them. Not when markets are favorable, not when prices are low, when your nation faces a crisis and production capacity matters more than quarterly earnings. Silver isn't optional for defense contractors. Raytheon can't build missile guidance systems without it. Lockheed Martin can't manufacture advanced avionics without it. Tesla can't produce electric vehicles at scale without it. Samsung can't make the smartphones everyone depends on without it. When those companies go to buy silver in a genuine shortage, they won't be competing against speculators or investors. They'll be competing against Chinese state entities that have been accumulating for 20 years, that control the mines and the refineries, that own the Shanghai Gold Exchange where price discovery now happens. And they'll pay whatever price those entities demand because the alternative is shutting down billion-dollar production lines. That's the wealth vacuum Rubio sees but cannot name. It's not that China is stealing our silver. It's that we built a system that legally requires our banks to sell it to them at discount prices, ship it to them in armored flights, and call it shareholder value creation. We wrote the rules, we designed the market structure, we created the arbitrage opportunity, and now we're watching the predictable result unfold in vault inventory data that anyone can access if they bother to look. The truly terrifying part? This isn't slowing down, it's accelerating. Those armored flights from JFK I mentioned at the beginning, they're not one-time events. They're scheduled routes now, regular deliveries. The banks have optimized the logistics because the arbitrage is consistent enough to justify dedicated infrastructure. We've industrialized our own strategic resource depletion. And every single day this continues, the $34 gap stays open, China's one-way valve keeps tightening, and our vaults keep draining. The wealth isn't just transferring, it's being vacuumed out of the West by a mechanism we built ourselves and can't turn off without breaking the entire financial system we've based our economy on. That's not a market inefficiency. That's a systemic design flaw with a countdown clock attached. Now let's talk about what happens when the countdown reaches zero. Because based on current inventory data and withdrawal rates, we're looking at weeks, not years. And the numbers are undeniable once you know where to look. COMEX registered silver, the metal actually available for delivery against futures contracts, has collapsed from 150 million ounces to levels so low that traders are starting to whisper about force majeure. That's the legal term for when a contract becomes impossible to fulfill. When an exchange has to tell contract holders, sorry, we don't have your metal, here's cash instead at whatever price we decide to pay you. It's the nuclear option in commodity markets, and it's looking more inevitable every single week. But COMEX isn't alone in this crisis. The London Bullion Market Association vaults, the traditional heart of global precious metals trading, are down 40% since 2020. These aren't small family operations. These are the institutional vaults that have anchored Western gold and silver markets for centuries. Bank of England facilities, HSBC storage, JP Morgan warehouses. The metal is leaving faster than new supply can replace it, and everyone in the industry knows exactly where it's going. Shanghai Gold Exchange inventories tell the mirror image of this story. They're at 10-year lows, not because China isn't buying, but because they are buying everything so fast it never sits in exchange warehouses long enough to be counted. The metal arrives from London and Zurich, gets purchased immediately by state entities and industrial buyers, and disappears into vaults and factories that don't report their holdings to public exchanges. It's not low inventory because of lack of demand. It's low inventory because of overwhelming demand that clears every available ounce the moment it appears. Let me make this visceral for you. Some industrial regions in China now have only 30 to 45 days of accessible silver at current consumption rates. That sounds like a shortage problem for them, right? But think about what happens when a Samsung factory or a Tesla production line or a solar panel manufacturer looks at that number. They don't shrug and say, we'll wait for prices to come down. They panic. They call their procurement teams and say, buy everything, pay any price. Because if we run out of silver for 48 hours, we shut down $1 billion facility and breach contracts with customers around the world. This is what traders call an industrial margin call. It's not speculators buying futures contracts hoping for price gains. It's manufacturers who need physical metal in their supply chains willing to pay absolutely anything to keep production lines running. When you're Samsung and your alternative is shutting down smartphone manufacturing, would you pay $120 for silver? $150? $200? At what price do you decide it's cheaper to stop making phones than to secure the raw materials? That's the bid that's coming. And it's going to make yesterday's volatility look like a gentle breeze. Now here's where this gets truly explosive, and why Rubio's emergency summit is really about something much bigger than silver alone. We need to talk about the shadow ledger. China officially reports holding 2,306 tons of gold reserves. That's what shows up in IMF data, in their central bank statements, and the official reserve figures they update monthly. They've been adding to this total for 14 consecutive months now, bringing gold to 8.5% of their total reserves. That's the public story. But forensic analysts who track trade flows and domestic production have been running different numbers. China produces approximately 400 tons of gold per year from domestic mining. That production doesn't leave the country. It's not exported. It stays inside Chinese borders by law. Multiply 400 tons per year times 20 years. That's 8,000 tons right there that never appears in export data. Then look at imports. Through Hong Kong and Shanghai, through direct bilateral deals with producing nations, through refinery shipments from Switzerland and London, China has imported over 20,000 tons of gold since 2002. These aren't secrets. These are documented shipping manifests, customs records, vault transfers that researchers have been tracking for decades. The metal arrives in China and vanishes from Western accounting systems. Added up, 8,000 tons from domestic production that stays in country, 20,000 tons from imports. That adds 28,000 to 30,000 tons of gold that exists somewhere in Chinese hands but doesn't show up in their official reserve figures of 2,306 tons. Where did it go? Off-balance sheet accounts, State Administration of Foreign Exchange, strategic holdings, sovereign wealth funds, People's Liberation Army reserves, private citizens buying gold bars legally, but those holdings never being aggregated into national statistics. Think about what happens when Beijing decides it's time to announce updated reserve figures. When they hold a press conference and say, actually, we've been accumulating for 20 years, our official reserves are now 40,000 tons, and by the way, the yuan is now backed by 40 to 50% gold. What does that do to the dollar bond market overnight? What does that do to Treasury yields when international investors realize China has been preparing for monetary system change while the West was focused on derivatives and paper markets? This is the ultimate nightmare scenario for dollar dominance. It's not a military threat. It's not a trade war. It's China revealing they've been patient, strategic, and methodical while we've been optimizing quarterly earnings. They've been converting paper claims into physical assets while we have been leveraging physical assets into paper derivatives. And when that reality becomes undeniable, the entire structure of dollar reserve status comes under question. But we don't have to wait for some future gold announcement to see the system breaking. It's happening right now with silver, in real time, with data you can verify today. 3 scenarios are converging in February, and all 3 of them end badly for the current paper market structure. Scenario A. Rubio signs an export ban tonight. The United States prohibits silver exports effective immediately, citing national security concerns. What happens? The paper price in New York freezes at $88 because futures contracts keep trading based on the last settlement, but physical metal becomes unobtainable. The arbitrage gap that was $34 becomes infinite because there is no arbitrage when one market disappears entirely. Industrial buyers in America scramble to secure domestic supply. Defense contractors call their procurement teams in a panic. And the Shanghai price keeps rising because Chinese buyers have months or years of inventory already accumulated, while our manufacturers are competing for scraps. Scenario B, the United States capitulates to market forces and allows silver prices to spike naturally. 88 becomes 100, 100 becomes 120, 120 becomes 150 as industrial shortage becomes undeniable and manufacturers bid against each other for limited supply. The arbitrage closes not through Chinese prices falling, but through American prices rising until they match reality. That's dollar devaluation by another name. The purchasing power of every dollar-denominated asset drops because commodity prices spike across the board once silver breaks loose from paper price suppression. Your savings, your bonds, your fixed income investments all lose value as real assets reprice higher. Scenario C, COMEX force majeure. The exchange looks at registered inventory, looks at open interest, does the math on that 356 to 1 ratio, and makes an announcement. Effective immediately, March futures contracts will be cash settled only. We're out of metal. You get dollars at settlement price, not physical silver. What happens to the paper market when the exchange itself admits it can't deliver? Every contract holder realizes simultaneously that they don't own silver, they own a promise that just got broken. The scramble for physical metal becomes panic as 356 paper claims chase each single ounce of real metal that actually exists. All 3 scenarios lead to the same place. The current price structure breaks and physical silver becomes unobtainable at paper prices. The only question is which breaking point comes first and how much chaos accompanies the transition. Given current inventory drawdown rates, we're looking at critical depletion in 6 to 8 weeks maximum. Some analysts watching daily vault movements think it could happen even faster. Here's what that means for you personally. Today's $88 price, the bounce from yesterday's $78 crash, might be the last chance to acquire physical silver anywhere near paper market prices. Once industrial buyers enter panic mode, once force majeure becomes real, once the arbitrage breaks, because there's nothing left to arbitrage, the game changes completely. You won't be competing against speculators. You'll be competing against defense contractors who need silver for weapon systems, against manufacturers who need it to keep production lines running, against sovereign wealth funds who want hard assets before currency instability hits. That 9% bounce everyone thinks is a recovery, it's not healing. It's the patient sitting up before the final collapse. Chinese state buyers said thank you for the discount and bought everything available. Western banks facilitated the transfer because fiduciary duty required it. The vaults kept draining because the mechanism has no off switch. And now we're in the final weeks where physical metal is still available at paper prices before those two markets separate permanently. You want to know what happens after they separate? Look at Venezuela, at Argentina, at Zimbabwe. Not because America is becoming those countries, but because they all share one common feature. The moment when paper promises and physical reality diverge is the moment when ordinary people learn the hard way that not all money is created equal. When paper currency buys less and less of real things. When savings evaporate, not through spending but through repricing. When the game of musical chairs ends and you realize there are 356 people standing but only one chair. Rubio knows this. The banks know this. The Chinese state buyers definitely know this. The only question is whether you know this before the window closes. Because that $34 arbitrage gap isn't a market inefficiency waiting to be corrected. It's a countdown timer showing how much time remains before vaults are empty, before contracts can't be fulfilled, before the paper market admits it was never backed by physical reality in the first place. The armored flights from JFK are still running. The Shanghai premium is still there. The mechanism is still executing. But the inventory data shows we're in the final phase. Not years, not months, weeks, maybe less. And when it breaks, yesterday's crash that scared everyone will look like the opportunity of the decade compared to what unavailable means. That's the math Rubio doesn't want you to see. That's the vault data your bank won't explain. That's the reality behind the 9% bounce and the emergency summits and the carefully worded statements about supply chain resilience. The store is being bought out while the doors are unlocked. And once it's empty, no amount of paper promises will magically refill the shelves.